So today's video is going to be on the subject of dollar cost averaging. What is dollar cost averaging? Well, dollar cost averaging is the ideal investing strategy for anybody who is looking to take a passive approach to investing. What does that mean? It means that you're looking to select investments and set up sort of a plan and then have it work for you, and you're not actively changing things around every couple of days, every couple of weeks. You're looking to set up an investment plan, choose investments, and figure out the amounts that you need to save, and then you're letting it grow passively. You're not really micromanaging it per se. So for the vast majority of you, you are going to be passive investors. That is going to be your investing plan. And as such, dollar cost averaging will likely be the investing strategy that you use in order to achieve your investing goals. Now, before we get into what dollar cost averaging actually is, it's really important to understand something about the economy. And so the thing that you need to understand is the economy effectively goes through fluctuation periods. It goes from low points to high points. So looking at a hypothetical graph, this might be what the economy, sort of a hypothetical look at what the economy goes through. It goes through these low points, and low points would be characterized by things like downturns, recessions, crashes. 2008, the mortgage crisis would be considered a low point in the economy. Typically, interest rates are really low. Companies are undervalued. They're doing poorly, so their stocks are trading for less money than, say, during a market high. There's typically lower employment, and all around the economy is not doing very well. There's typically very low growth. And these high points are typically characterized by high interest rates. The economy is doing really well. Companies are valued quite highly, so they're trading at a premium. Things are expensive. There's a lot of growth. There's a lot of employment. And so the economy will fluctuate between these points. It will go through these highs and lows. And so that's really important to understand why dollar cost averaging is such an important investing strategy. So what is dollar cost averaging? Well, it's very simple. Effectively, it's an investing strategy where you choose a set amount, could be $100, $50, whatever it is, and you invest that consistently on a timeline. So you might invest it every month, you might invest it bi-weekly, but the key is you do it consistently. Now, it may seem very simple as sort of an investing strategy. You're just picking an amount and then you're investing it set every sort of period that you're doing investing, but there's a very powerful rationale on why it is a very effective investing strategy. So getting back to this graph, the highs and lows points. Well, what point do you think it's more appropriate to invest in? Where do you want to focus? Where do you want to go? Do you want to invest at low points or do you want to invest at high points? Well, you always want to invest at low points. You want to invest at these market lows because when you invest at a market low, stocks and other investments are cheaper. Companies are undervalued compared to where they would be at other points because the economy is not doing very well. And so let's say, hypothetical in this case, in this market low, let's say that a mutual fund is $10 a share at this point. So let's say you had $100, you invested that $100, that's what you're investing in dollar cost averaging. You put that $100 in, you can get 10 shares in a mutual fund. Then at a market high, when the economy is doing well, the value of the market increases, so companies are more expensive to buy. The same mutual fund, say here, would be $25 a share. So you'd only be able to buy 4 comparatively to the 10 that you would be able to buy at a market low. The other huge advantage of investing at lows is, as the market returns, as it returns from the recession, it gains in value. So let's say you bought it at $10 here, a share, it might increase to 12, to 15, and eventually it goes to that $25 at the high point. The reason you want to invest at a low point is because stocks are cheap and they gain value as the market returns to a market high. You want to avoid investing at a market high because when you do that, you're paying a premium for those stocks and other types of investments, and they're going to lose value as the market returns to a low point. So you want to invest at low points, sell at high points. That's the overall goal of investing. Again, it seems pretty straightforward, but there's a huge issue. This is sort of a hypothetical look at what the economy goes through. This is more accurate of what it actually looks like. As you can see, it is a lot more unpredictable. This is very easy to see. Okay, this is going to be a low point, and then it goes to a high point. It's very easy to see that on a hypothetical graph, but in reality, the economy is very unpredictable. There's a lot of variables that play into it, and it's very difficult to actually understand what is a market high and what is a market low. It's fairly simple looking at the graph right now. You can easily see that this is a market low, this is a market high, and this is a market high. But when you're actually going through the events, it's very difficult to know if this is going to be a market high or if this is going to be a market low. It's very actually difficult to figure out the specific events and specific times when these things are going to occur. It's possible to understand trends, to see where things are going, but it's very hard to actually get the specific amounts to know if this is going to be the highest point of the market, if this is going to be the lowest point. It's very difficult to actually get the specific amounts, and people spend their entire lives trying to determine those values and those times, and they have limited to sometimes success doing so. But being a passive investor, you don't want to have to sink hours every week looking at the markets and analyzing where they're going. And that is the power of dollar cost averaging. What happens is, when you're investing a set amount of money consistently in something, you're going to take advantage of those market lows or market highs without actually having to do any analysis. What happens is, let's say you're investing using the same numbers as before. If you put $100 in here, you're going to be able to buy, using the same numbers from the previous example, 10 shares of that mutual fund. At a market high, you're only going to be able to buy 4 because it's trading at $25 comparatively to the 10. So at market highs, if you're investing a consistent amount of money, you're going to be able to purchase less of an investment. At market lows, you're going to be able to purchase more with the same amount of money. And so what happens is, when you're consistently investing a set amount of money, you're going to be buying more at market lows, which is where you want to invest, and less at market highs, which you want to avoid. So with dollar cost averaging, and why it's so powerful as an investment strategy, is you don't have to put any thought into it. You just choose whatever specific investing amount you want to put in. Let's say it's $100 a month, and you do that consistently over a long period of time, and you will take advantage of market highs and lows without having to do any research beyond choosing an investment. So that is the power of dollar cost averaging. If you are going to be a passive investor, it is going to be what you use. And so again, the key here is that it's consistent. You have to choose an amount and be consistent with your investments, and that's how you take advantage of dollar cost averaging. Hope you enjoyed the video. As always, if you like it, I would very much appreciate it if you could share, like, and comment. It helps me grow the channel.